Hello, everybody. Welcome to the Talk With Kiet podcast, where we connect people, ideas, and capital to help make a difference in the world. Today, I have Eric Saraniecki, the co-founder of Digital Asset. Eric and I will explore his extensive career and entrepreneur journey, as well as discuss the future of digital assets. Eric, welcome to the podcast.
Thanks, Kid. Thanks for having me.
So, Eric, as part of tradition of this podcast, we usually start with the origin story. But with you, I want to start way earlier.
Right.
Because I understood you went to the University of Chicago, but that was not your original intent. You wanted to go to Air Force? Like, what happened?
Yeah. Well, I mean, I was as a kid, I was obsessed with flying. I was one of those, 80s kids that was hooked on Top Gun, and that was my obsession. And I was very lucky to go to a public school that had a flight class, so I got to fly Cessnas and sit in air simulators and things along those lines in high school. And I got really hooked. So of my college application, I think I did 32 school applications. 31 of them were Air Force ROTC, and one little football coach visit to the University of Chicago. My college application year was the 9/11 year, and so the applications into the academies and into all the armed forces went through the roof. They just started disqualifying people for all sorts of reasons. They just needed to find reasons. And as a kid, I had an allergy that disqualified me. So
Yeah.
31 out of 32 schools I could still go to, of course, but I had none of the Air Force connection or ROTC connection and any of those things. And I was like, all right, well, what am I going to do now? And that was kind of the first time I gave Chicago a serious look. And honestly, once I went and visited, it was exactly the right place for me. So I'm very lucky. It was like one of those incredible lucky bounces that really came my way. I would not have done well, I think, in the military. I'm a little bit more of a rebel, and I have a problem with authority, on a personal level. It wouldn't have been a good match for me. So I got very lucky. in that regard.
Well, I'm surprised Chicago has a football team.
Well, yeah, I mean, it used to be a good one. It used to be quite prestigious. It was my favorite kind of joke is to say, name the team that played Notre Dame and never lost to them. I mean, it's Chicago. But I think somewhere around in the 70s, they ditched the program for, 70s style reasons, I'm sure. And they've been very slowly building back athletic credibility. I think the girls' soccer team won the D3 division this year, or maybe the men's. I can't remember which. But I mean, the soccer teams are always good. The basketball teams are pretty consistently good. Football teams were consistently terrible. But still, it was something to do, something more than just class, like most Chicago kids would do.
Yeah. And so how do you get your start in finance then after Chicago?
I mean, for me, like when I was sitting down and I was saying, okay, I was going to do aeronautical engineering, I was going to be an engineer of some type, and then Chicago, it's like, well, what do I do at Chicago? There's no applied sciences at Chicago. It's all kind of theoretical. I said, well, I don't know, maybe I'll do econ. People that do econ go into Wall Street, and then they make a lot of money, and then I'll buy a plane and I'll fly a plane. That was like my perverse logic at the time was, okay, here's another way maybe I'll get to my dream, is just do it kind of indirectly through wealth. And so that was one of the motivators and thoughts. So when I went to Chicago, I decided to take econ as my major, and that was brutal. I don't remember exactly the numbers, but I started with maybe 100 kids in the class or something along those lines, and graduated with like 10 or 20. There's just a ton of people get squeezed out. Chicago's used to be a pretty aggressive curriculum and pretty aggressive school to go to. I think that's changed a lot in the past decade. But yeah, I'm really glad I did it. It was my most positive education experience, was being in Chicago. And everyone at Chicago in econ is looking at finance, right? So to answer your question, that was the main thing. I got lucky again, though, in the sense that in the football team, we all had a fraternity. We all joined the same fraternity. And that fraternity was just like a funnel to the street. Everyone there went and worked at a bulge bracket bank or some of our benefactors worked at banks and helped us get internships, or there was actually a small contingent of the house a year older than me that had gone into DRW. So it was a nice kind of warm introduction to DRW at that time.
And you actually traded physically at the pit, right? Before things got electronic. What was that experience like?
Yeah, I mean, good timing for me. I mean, when I went into trading, that was 2005. So some of the markets, there was still a vibrant pit market. And, DRW would hire for this kind of crossover person who was, I don't know, physically imposing, but also sharp. And that was a good pit trader, someone that could get in a fist fight, but could also do some basic mental arithmetic and make good risk-based decisions. So I think that if I were interviewing for DRW today, I almost certainly would not get the job. They're much smarter people now and much stronger computer science skills than I have. But back then I was kind of the archetype. So I got to start down in the pits. I started in Chicago in the Treasury options pits, which were incredibly slow and boring. It was like the lowest volatility, I don't know, that I remember in the Treasury markets for a long time while I was there. And some of my fraternity friends were in New York and were working in the complete opposite world, which was natural gas markets. So I begged and pleaded to get out of Chicago, out of the Treasury markets, and over into the New York gas markets, and managed to be successful in transitioning over that way.
So you were there when Amaranth blew up with their net gas trade.
Yeah, my first, I was in the pits as maybe about a week when then Amaranth blew up, and I think it was 5 or 6 billion lost in 5 days through the pit, and that was a pretty wild experience. Back then there was something called a local, which I think very technically still exists, but it was the prominent way the pits were constructed in the day with market makers. Locals were people that largely backed themselves or borrowed money to back themselves or worked for small proprietary trading firms that found ways to back people. But so many people lost money, not just Amaranth, right? So many people got run over in the process of all that money coming through the pit, that to me was kind of the end of the local at the NYMEX. So that was a wild week. I saw people lose their livelihoods in a matter of seconds. That was just kind of a jarring experience. And I'd go home at the end of every one of those days and just kind of stare at a white wall for an hour and try to decompress. It was a pretty intense week in the pit. I'm really glad I got to experience it. I'm really glad that we were on the right side of a lot of things at that time. No credit to me. I was, just a junior nobody, but we came out of that whole event in a pretty good position, and got to kind of experience, what small markets are really like. Everyone knows each other. Everyone knows each other's positions. People are meeting up for drinks after work and, putting on huge, massive trades, out of almost pure ego and jostling, and seeing the result of those things over the course of the week was, I don't know, just a very sobering week, to be honest with you, but very interesting.
Yeah. And how has that transition from physical pit to electronic influenced your career as you've seen what technology can do to a whole market?
Yeah, I mean, DRW was an awesome place to be from 2005 to 2015. Like, an incredible transition of markets. When I first started in the Treasury pit as a trading assistant, my job was to print out all the different expected potential pricing sheets. So we would take a two-wheeler of just paper, wheel it across town over into the market, down into the pit. And by the time we left, DRW was doing global microwave, event-driven, anything versus anything. There was even some AI trading going on. Just an incredibly fast 10 years of technological innovation in the front office. And DRW was well positioned to be a place for people to experiment with that. There was a lot of entrepreneurship within the firm. It was heavily encouraged. I think we were one of the first teams, my desk was one of the first teams to embed developers into it to help us build tools and strategies to kind of help navigate the electronic markets. So it was just, I think the most important thing is it beat into me over 10 years that there's no room for complacency in markets. I think every time we found a strategy that worked, we knew that it had about 6 months of life on it. So it was just like a forced, constant, great, that worked, but what's the next thing? What's the next thing? What's the next thing? And that I think it's almost like in software. Now that I've been about 10 years in software, it's very similar in mentality of just this constant flow of innovation and figuring out what's the most valuable thing to do next and trying to be really nimble about it. I think there's a lot of similarity in that regard. It's been good. About 20 years of just like nonstop rethinking, throwing away whatever I've done so far, not being religious about it, not being, people get emotionally attached to things that they do. I don't really have that sort of thing. So just a lot easier to kind of do the next thing, do the next thing, do the next thing. Almost 20 years of that. And I sometimes call myself like a stateless human being. I don't really hold on to anything.
That's right. Now, I heard somewhere that you have somewhat of the Guinness Book of World Record of losing Bitcoins.
I don't know if it's an official record. I'm not sure I want to go so far as to try to prove that it's an official record. That would be maybe a little too.
Tell me the story how you got into Bitcoin. Like how did that start?
Yeah, I mean, it was, well, at DRW, there were a couple people that were very early to Bitcoin. Like one of the guys at DRW, Mike Komaransky, he's one of the original pizza transactions. Most people know about the one, but there were a few, and he did, I think, the second one or maybe the third one. So there was an awareness of it very early within the firm. Not from like a firm level thing, but just, different people talking to each other. And, Como and I would have all sorts of crazy schemes and ideas on how to kind of acquire some and what to do with it. And we would constantly bounce ideas off of each other about what the markets would be and could be. And there was a period of time that I did a lot of Litecoin mining. I think that was 2012. That was a big sort of, thing for me personally. He had a bunch of different initiatives going on that he participated in. We were pretty active in the early days of some of the IRC channels where people were really kind of formulating what they thought the whole space was worth and what you should use it for. And again, not that I was an influential character in any of that, but to be a fly on the wall and just kind of be influenced by it. My earliest sort of thesis was wrong, by the way. It was completely wrong, but there was this hype and this misconception that Bitcoin was private, right? Which I think a lot of people still believe somehow mistakenly. But I was like, oh, private internet money, that has incredible utility. Look at things like Silk Road. Again, not that I partake in any of that, but I just recognize there is utility in this thing. And I was like, okay, that's an interesting thing to speculate on. But by the same token, I recognized that it was very unclear what the rules on purchasing this were and holding it. And I was very nervous about it. So every time the market would go up from like, I don't know, the first ones I bought were a penny, and then maybe I paid like 50 cents for some, like, it goes to $20. And people are telling you you're going to go to jail because you're participating in the market and you're doing everything you can to try to figure out how to be somewhat clandestine about it. It goes to $20. I sold. Like all the lunatics I worked with early, they never did. They never sold. They never sold anything. I bought and sold. I was kind of in and out pretty regularly. That was maybe my big mistake. So, I lost either through, selling coins very early. So that's not really losing. That's just a bad decision. Or I lost through, I used to give people birthday cards with a bunch of Bitcoin in them, and all those people lost them. Or, I gave a friend a couple thousand Bitcoin for some Knicks courtside tickets one time, and he lost them at Gox. And I used to walk around with physical Bitcoins, the old Cassius coins, and I lost them on the beach in Bondi. And so I've kind of done everything in terms of how to lose it. Lost keys, lost computers, lost wallets. I mean, again, it's just one of those things where it was just so early and no one really took any of it very seriously, and it wasn't clear how on the up and up everything was. I'm not sure I ever gave it the seriousness that it deserved at that time. Again, where some of my friends were I have some friends that bought at that same time or mined at that same time or were very aggressive at that same time, and they still haven't sold anything, which is insane to me. It's insane to me, but
Yeah.
good for them. They're very rich, and I'm very stupid.
Now you were trading on Mt. Gox when it blew up, right? And with the government auction, you were involved in that process.
Yeah, there weren't a lot of venues to trade on in the early days. It wasn't just Gox. We also traded on BTCE, which was, I don't know, I think it was run in Bulgaria by, I can't remember by whom, but supposedly by the people that laundered all the Gox coins that got stolen. There weren't a lot of good options back in the early market days. And yeah, personally, I never lost anything in Mt. Gox, which was good. But yeah, we used to trade against that venue, and I don't know that we did at Cumberland, to be honest. I don't think we ever, because I think Gox blew up pretty much right around the time we started in Cumberland. So I don't think Cumberland ever touched it, but personally, yeah. And at Cumberland, yeah, one of our first big trades was winning one of the Silk Road auctions. There were a few that year. We lost the first one to Draper, if I remember correctly. The market was tanking, and he bid like 20% through the spot price.
Wow.
Well, at the time, there was this narrative, and I think the narrative is coming back a little bit about how clean coins should trade at a premium. Right? And so being able to buy coins directly from the federal government after they've effectively, seized them and clean them, right? Because you're buying from the government. His argument at the time was, you're buying the cleanest coins you can buy.
Yeah.
And he was also super bullish the market. He thought the sell-off post-Gox was kind of overdone and blah, blah, blah. But so he was pretty aggressive in that. But the next auction, we were down another, 30 or 40% from where he paid it. So I don't think he was too aggressive in the second round. And we ended up winning most of that auction, which was nice. I'll tell you another time, but one of our mutual friends won the last tranche of that auction.
Okay, I think I know what you're talking about. Now let's backtrack a little bit. How do you convince DRW to launch and start Cumberland and actually be in the crypto business?
So, yeah, that's a good question. There was a lot of skepticism internally, and again, I think rightfully so, about participating in the market. I had been trading very illiquid natural gas futures for a few years in New York. That was the desk that I built. And there was a guy, John Arnold, from Centaurus, ex-Enron, super successful guy. And his business model was, I'll make you a market in anything in the market for any size that you want, but you got to cross the two-way. You're not going to middle it. You're not going to do anything low. And if you called them to get out, it was really bad. You were losing 25, 40% of maybe where you had it on from, maybe more, but you were never losing 100%. And if you had to get out, you could. He was there for size. And in many ways, I think he really created that backdated, long-dated natural gas market because it made it possible to enter the ecosystem. So I said, let's be the John Arnold of crypto. Let's be this large liquidity sink that'll make you a market on anything that you need. We know how to manage risk. We know how to take a point of view on this. We'll get a ton of edge to be able to get into these markets. And it'll also increase the TAM of the market because it'll make it more attractive for someone to enter. Right? If it's a Roach Motel where I can only buy and I can't puke out without losing 100% of my money, that's a really big barrier to entry. So that was one of the pitches that we made. That wasn't sufficient. That didn't really convince them. Yeah. They're like, oh, you just want to bet our money, and backstop a market we don't care in. So the reason it was always called Cumberland Mining was because the one business plan that did seem to connect with them was just the pure cash flow economics on mining. So we put together a whole plan about we can acquire power here and ships here and do this, and based on the following probabilities on difficulties and things like that, this is what we think the cash flows of the business would be. And we would have trading around that, so we'd be vertically integrated. We'd have some edge. We'd be acquiring, and we'd be able to trade it. And that that kind of, I think, got them over the hump. And again, to their credit, they agreed to go forward. And then the mining conditions got horrible right around the time we wanted to start it, where difficulty and price dislocated massively and just no longer made economic sense to mine. So we just ended up just trading. We never actually did any mining. Maybe they have. I don't know. I'm very far removed from Cumberland at this point. I did about, we started it and I was around for the first year and change of it. So it's a very different organization and they have very different perspective than I'm sure we did at that time. But as long as I was there and I was aware, they never ever actually did mining.
Yeah. So how did you decide to go from there to starting digital asset? At what point you said this whole blockchain crypto thing, we need to institutionalize it?
Well, there's a couple things. There's one, like, why did we come up with the idea to found DA, and then why did I decide to go do it? So on the first one, our mandate was to use Trading Edge to build a long portfolio. And if you're long something, I mean, one of the other things you can do is you can help invest in the ecosystem to increase the TAM of the thing you're long, right? So it's a pretty constrained ecosystem in 2013, 2014. We didn't have institutional participation. It was still a dirty four-letter word. It was kind of like, being the drug dealer in a party, everyone's kind of looking at you, but not necessarily talking to you, sort of a thing. Like, it was still very different than it is today. Today, I find very surreal. So we said, what is something we can do that'll increase the TAM in this marketplace? And we were dealing with very real counterparty risk. And, when you trade on a crypto exchange, it's unlike any other asset class on earth. You actually deposit at the exchange, and you have this massive counterparty risk to who you've deposited with, because a crypto token is a bearer asset, like a dollar. So the moment you put it in their wallet, it belongs to them. And if they go bankrupt, or if they fall apart, or they steal your money, yeah, you can sue them, but you're going through bankruptcy proceedings and you're trying to recover something that it was a bearer instrument, so they held it. They had a liability to you, but they owned that asset.
As we see now with FTX.
Yeah, that's what makes me really upset about the world, is that, like, this is a known problem that happens every, 6 to 18 months in the crypto market for over a decade, and still we haven't solved this problem. I'm a little cynical about this because, unfortunately, a lot of the crypto exchanges have built their moat around their custody business. And so I think there's a lot of lobbying and a lot of effort that goes into preventing pulling apart the vertical exchange in the crypto space. But in every other market in the world, I have a custodian, I have an FCM or some cleared access to a marketplace. I take zero counterparty risk at the exchange. That's pure price discovery. And there's a lot of wholesale infrastructure to let me know that when I match on exchange, I will be able to settle. I will be able to get my assets. And there's so much interesting regulation and rules, and they're not arbitrary. They are things that have been built on the back of lots of hard lessons learned in traditional finance. And there's still more to learn. I'm not saying it's foolproof or bulletproof or perfect, but I'll tell you, one of the first things is you don't give a bearer asset to some private company that is also your exchange and you have zero visibility into. Like, that's an obvious problem, right? So go ahead.
I mean, the one thing to add is, in the FTX scenario, as far as I understand, their customers in Japan did not lose money because the Japanese regulator forced them to put tokens into a cold wallet, and essentially prevented them from stealing that, the tokens that are sitting in there.
I think we still don't know what people have lost because we haven't gone through the full bankruptcy proceedings.
Yeah.
Right. So I do know that if that had been cash, it would have belonged to the bankruptcy, because that's just the way cash is well treated and understood. Like, when the depository goes bankrupt, the cash rolls into the bankrupt entity, then the trustee figures out who they want to disperse money back to and at what ratio, right? Cash deposits belong to the party that are holding it, right? For bankruptcy law purposes. I think crypto should be treated the same way. Coinbase came out and said crypto should be treated the same way, and the market trashed the stock for it, for making, I think, a very logical, true statement. So we don't yet know what the bankruptcy trustee is going to be able to claim and pull out. Those funds may still be there, which is good, but it might get mutualized into the losses of the umbrella company. I don't know that we know the answer to that yet. And I think that while it is really good to have the regulation to say, okay, you have to have this stuff maybe in a cold wallet or something a little bit more transparent, I still think that's a bad answer. And I think that the proof of reserves is a bad answer. The right answer is get custody away from the exchange. Get it away from the exchange. Move it into an entity that is supposed to be a pure custodian. It's regulated as a pure custodian. And it doesn't do anything risky. I don't have massive counterparty risk to someone taking principal action in the market, provably through regulation and structure and all sorts of stuff like that.
Yep.
And actually make sure that these price discovery venues are price discovery, not depositories. I think that's the right answer. I don't think that's going to happen. I think it's pretty clear that after a decade of this needing to happen, it hasn't, unfortunately. But still, I would fully support anyone trying to do that, and I would encourage people to try to make that happen to the extent that they can. But so to come back to your original question, we started DA thinking we would build a universal clearing and settlement system for the exchanges, and that would be a way that the enterprise market could come into this ecosystem. Because in 2013, 2014, it was impossible to get banked as an exchange. So what a lot of people did is the CEO created personal bank accounts in odd jurisdictions. And if you wanted to trade on the exchange, you were wiring millions of dollars to the CEO's personal bank account. So, yeah, I mean, the counterparty risk was insane. Like people, it still kind of upsets me that people talk about trading across exchanges in the crypto market as arbitrage. It is not arbitrage. It's a credit default trade. You have counterparty risk, you have credit risk, you have to be aware of it, you have to calculate it. Money on Coinbase has a different credit profile than money on Binance, than FTX, as we've seen, right? So I'm not going to say which is better or worse. It's not for me to decide or care or any of that sort of stuff. They are different, and it can justify the price differences between these venues. So having depository risk to these types of venues, I think is very, very risky, and I continue to support any industry initiative that would remove this commingling. DA didn't get into that business. We didn't ultimately pursue it. I think the market conditions weren't really there when we started looking at it, and we pivoted to a very different path very early on in the company's life cycle. But it's still an unsolved problem. I've seen a couple companies with some interesting offerings, but it's not widely adopted. That's what I mean by it's not a solved problem. Yeah. Unfortunately.
And where do you see, I guess, the world of blockchain heading towards? Because conversation on the Davos, everyone's really taking blockchain as a technology much more seriously, and you're seeing now traditional markets, trying to now really adopt blockchain as technology. Like, or the industry itself heading the right direction, or things to change, and how does DA fit in all this?
Yeah, I mean, I think the way I try to, before I jump into any specifics, I try to start with kind of an analogy. I think a lot about the crypto markets today, the way that digital music and digital video came to exist. So if you go back to the way that we broke kind of the only way to consume music was a CD.
That's right.
What happened was we had these decentralized internet capabilities around torrents, like Napster, like the Pirate Bay, and people started fractionalizing their CDs. Right? They would turn it into an MP3, and they would post song by song on the torrents. You could get an album, but people generally went shopping for songs. And it was peer-to-peer, decentralized, censorship resistant. It had to be, because doing that at that time was, questionably legal. and the way that the technology was built was not safe. People knew what you were doing. You could get sued by Metallica. You could download viruses. A lot of the songs were fake and they were viruses, or something to totally mess up your machine. So it was very unsafe ecosystem to participate in. But at the end of the day, it established that was a way people wanted to consume music, both in a new business model way and a new format, new distribution platform. And that demand became so solidified and clear and quantifiable and obvious that the industry had to respond to it. And then we saw them go and partner with Apple and create iTunes. We saw them partner with Spotify and create streaming. We saw them later partner with Netflix to stream movies. They partnered and built a consortium of Hulu to stream TV shows. All of that, I think, is completely thanks to torrents establishing the demand and really threatening the incumbents that if you are not going to solve this problem, someone is going to, in a way that's just not good for anybody. It's not good for the consumer. It's not good for the producer. It's not good for the artist, but it's going to exist because this demand is so unquenchable. And I think that we're seeing exactly the same thing happen with digital assets. We have these fully transparent, censorship-resistant, decentralized networks that are trying to find ways to create digital assets and investment vehicles and capital formation vehicles and business models. And I think that they've arrived. It's very clear that the demand is completely there. And it's up to the industry now to step up and find safe, scalable, legal, meaningful ways to satisfy that demand with the asset classes that they are responsible with governing for all of our benefit. Just because I put the deed to my house on a decentralized system doesn't mean anything. Like, so many of our assets are rooted in the local legality of what it means to be a holder of that or on that register, or what rights that entitles you to. So just putting some record in a decentralized system doesn't actually solve 99% of these problems. But again, I think if you do the analogy here, ETH is like Napster. It's absolutely established that you must solve this problem, and now it's just up to the industry to do it in the right way. And at DA, we believe that we're building all the technology that enables those entities to come and build new business models, build better digital assets, build better existences for the investors, build better experiences for participants. It should not be lift and shift. I think too often people hear the word incumbent and they go, oh, they're going to do the same shit they did, but in a new way, in a new venue. I don't think so. I think that, similar to iTunes and Spotify were different ways to consume music. It wasn't just, hey, here is a digital CD. They were different ways to consume it. The business models have to change. Adopting the technology has to change what you're doing. So just because it's an incumbent doesn't mean it should be a bad experience. So we're trying to build all the technology and the expertise and the capabilities to enable those parties to satisfy this demand with real-world traditional asset classes.
And one thing that most startup will envy, digital asset, and what you and the team have done, you guys managed to raise a godly amount of money. Talk to the audience about that journey of fundraising and how you managed to raise so much money.
Yeah, I mean, I think honestly, there's a lot of luck in this. The timing for us was very good. We happened to be raising in a lot of the up cycles in the market, both hype and pricing, and I think that did us a number of favors. But then also, we made the decision to always work with and take money from those who would be our customers, or would take the time to really understand how it's not just some crypto thing. And so we never really got into the venture space. And a few $1 million from JP Morgan is a lot of money, but it's not necessarily a lot of money to JP Morgan, right? So just kind of putting together a group of parties where it was a reasonable amount of money for them individually to learn, explore, see what's possible, potentially become a customer. For them, it was like very justifiable. And then we just happened to put together a lot of people like that, right? We have a lot of investors that are our customers, and so that became very symbiotic in that regard. And I don't know if that strategy would work for anyone else. Like I said, I think it worked really well because of the timing. Right? We entered the market in 2014 when people were just really starting to think about what is blockchain, how is that different from Bitcoin, why do I care? And so we got a lot of kind of, this is a cheap way for me to learn investments. If we had tried to start DA in 2019, after I think that people had already started to form their idea, I don't think we would have been funded as much, but also I think we would have been a lot more aware of exactly what we were trying to solve and how. So we might not have needed as much, right? It's just kind of very early, right types of participants, good proof points. We've had projects and customers and working on real things pretty much the entire time DA has existed. So having good customers, having good use cases has always reinforced that those are good investments. So yeah, I think it's just a number of different things, and just you got to be good to be lucky. But there was a nice bit of luck involved in that too.
No, totally. And so, what is your view in terms of the utopia state for the industry?
Yeah, I mean, I don't know. I struggle a lot with like the more anarchic components of the crypto networks. I also wish that there was a little bit more objectivity about what the state of the technology is relative to the vision, right? And so what I mean by that is I've always been extremely skeptical, even back in 2010, 2011, about Bitcoin as a payment rail, because it was very clear it didn't have kind of payment rail scaling capabilities, even conceptually. I still very much like Bitcoin. I'm not saying this to be negative about Bitcoin. I think that its utility is not to be an everyday payment vehicle for a cup of coffee. Now that's improving with things like Lightning, and maybe there's a way we get there and all that sort of stuff. But I wish that often people would say, okay, we're trying to be, I don't know, the internet for assets, and here's where we actually are. We're a 10 TPS, fully transparent, risky, legally unclear ecosystem. What is the path to get from one to the other? You never really hear the discussion about the path to get there, and then the critical questioning of, does that path actually make sense? Right? Like if you were going to start a startup, you've started many startups, right? Like what you're talking about. You have to sit down and have a thesis, not just about, okay, well, here's a problem. It's here's a problem. Here's what I can build to solve that problem. Here's how I can take this to market. Here's how the market will respond to that. Here's how it responds enough to that I can continue to invest in it and solve the next problem. There's a whole narrative that has to go into it. And I think we're missing the narrative on every one of these public chains today about how we get from where we are to what they're selling. And I think that there's this perverse incentive where, because everybody has a financial stake in the success of the network, they're afraid to critique it objectively. And so we're woefully short on objective critiques about what exists and how it's built, and how it's designed, and how it's going to map to the goals. And so I'm mostly just upset about that, right? And if you look at something a little bit more objective, like generally the tech space, I think people are more critical. Like the story I sometimes tell is, MongoDB was a total laughingstock for a while, very early on. It was people absolutely thrashed it, and I don't know personally, but from what I read, justified dropping data, losing data, mutating data, like all sorts of, like, there's a database. It's not supposed to do that, right? So people were absolutely killing Mongo in the early days. But, and again, they took the feedback on board and they continued to deliver value and get better. And now again, I'm not an expert on this, but I understand it's probably a much better technology than it was then. It's a very healthy company. And they took that path from, yeah, we're rough, but it's early, we're going to get there. And they went and executed on that. A lot of these other public networks, it's like, yeah, it's rough, but we're early. And that's enough. As is, we're perfect. We're like, no, I don't have to change. No, this is exactly if the world has to come to us, we're not coming to the world, they're coming to us. What do you mean you need privacy? No, total, complete, radical transparency is what matters. What do you mean you need to have some, asymmetric control over your assets? Completely, totally decentralized assets is the only thing that matters. I'm like kind of blown away with almost an adoption of the shortcomings as if those are features instead of recognizing them as bugs. And I think maybe the best example of this is, Zuko, who runs he doesn't run Zcash. I know it's a decentralized organization, but
yeah,
heavily influential, member of that community, helped get it off the ground. He talks about this all the time. He's like, Satoshi talks about how the lack of privacy was a problem for Bitcoin. But now everyone's kind of adopted its total transparency as if that is the value. And it's not, right? We need to just be more honest about the shortcomings of the things that exist, and then have a conversation about, can we solve those problems? Because in some of these instances, we can't. I think we're on a path where some of those things are not solvable with where we are today. It needs a much bigger change, a much bigger rewrite, especially when it comes to privacy. Privacy to me is the big one, where all of the integrity of these systems is built around complete transparency. So trying to add privacy to it after the fact is conceptually something I don't understand, right? Like, your system relies upon knowing all data at all times. How are you going to bolt on the concept of privacy to that? That's the sort of stuff that I think if you would have a more objective conversation, we would get to better outcomes. So anyway, this is a bit of a soapbox for me. I think that we need to be collectively more critical about the shortcomings of the tech that does exist.
Yep.
People need to accept that, and then we need to have a plan to fix it and be objective about whether or not that plan actually solves the problem. But there's a lot of marketing and misconception and hype in this space right now that doesn't stand up to basic logic and critique.
Yeah, no, 1,000%. Eric, thank you so much for being on today. That was brilliant. It's quite insightful as one. It's also an amazing story and journey that you have throughout your career, and what the digital asset team is doing. Usually what we do in the end is really about you and what you need from the audience. So what is your ask from the audience today while we have you on?
Yeah, my ask is to take a look at what we're doing at Digital Asset with Daml and Canton. We've built a smart contract language and a privacy-enabled blockchain that I think actually can meet the Internet of Value statements that people keep bringing up. It's commonly misconstrued as a private blockchain. We don't see ourselves that way. We see ourselves as a privacy-enabled blockchain. We think that the future is not fully public, fully private, fully permissionless, fully permissioned. It's some hybrid that looks and feels a lot like the internet today. Anyone can join the internet. Anyone can run a browser. Anyone can launch an app. It's permissionless in some regards. Not anyone can join chase.com. And even when you do, you can't see everyone's bank account. So it's permissioned in others. So this granular configurability of applications in the same ecosystem with composability and privacy is really our conceptual design for how we build blockchains. And I encourage people to take a look at the types of projects that we're working on. We're managing tens, if not hundreds of billions of dollars of repo in certain applications. Bonds are being issued, structured products are being issued. Look at the customers that we have. Look at the asset classes that they're managing and ask, is that because of the differentiated capabilities of this technology and try to map those concepts to each other. What about this new, radically new way of building blockchains works for those types of institutions? And can that ultimately deliver the vision that we have to completely change our financial infrastructure and improve it away from messaging and reconciliation and into smart contracts and consensus? How do we migrate our markets in that direction? What do we need? And honestly, just give us some feedback. Let us know what you think. Consider us against the norm. And we are very different. We are fundamentally designed from the beginning in a different way. Challenge your priors, look at what we do, and consider if whether or not what does exist versus us, which is conceptually on a path to meet that collective vision that I think we all share. So that's really my main ask. And of course, feel free to reach out if anyone would like a personal guide through that journey. There are plenty of people at Digital Asset that can help do that, myself included.
Great. Thank you so much, Eric. And as usual, thank you to the audience for your continued support. It was interesting, someone in my network pinged me this morning and said, "Hey, I saw your previous podcast was amazing. I can't wait to listen to your conversation with Eric." And these encouraging messages is what keep this channel going. So with that in mind, next week I will have Jonathan Block on this podcast. Jonathan is the founder and CEO of Exchange International Data. John and I will talk about his extensive career, entrepreneurial journey, as well as how to build a data business. Stay tuned to next week. Thank you, Eric. Thank you to the audience for your continued support.
Thank you, Kiet.
Till next week.